I'll briefly explain to you how a charitable trust works.
Oh,
So, a charitable LLC. So, you set up an LLC, and let's say it's got 100 membership units. Okay. Um, and what you do is you transfer assets into the LLC. Transferring into the LLC doesn't trigger a tax event. Does not trigger a tax event.
okay.
Then what you do is you donate 99 membership units that are non-voting to a public charity. You keep the remaining one membership unit, which is a voting unit. Okay. So the entity is technically owned 99% by a public charity. You own 1%, but you control the LLC. So now you sell the asset that triggers a capital gains event, a tax event. Well, because 99% of it is owned by a charitable entity, 99% is not taxed. Only 1%, the 1% you own is taxed. So you pay 1% of tax, okay? But you still own and control, well, you still control the LLC. So then what you do, now the LLC has cash. Let's say it's $500,000 in cash. Well, what to do is the LLC then loans the money to you. When you receive a loan, that is a non-taxable event. You're not taxed on that money. Now, you do have to pay it back. You have to pay it back with interest. So the interest that you pay that goes to the LLC, 99% of that goes to the nonprofit. 1% goes to you. And so, but now you've got $500,000 that you didn't pay no tax on, that you're paying a low interest rate on, that you can now go and do what you want to do.
Interesting.